Picture this. Over 1,000 banks collapsing like dominoes. Taxpayers forced to pay $124 billion to clean up a mess they didn't create. Entire life savings vanishing overnight. Small-town America watching their local banks, institutions their grandparents trusted, suddenly padlocked with federal seizure notices taped to the doors. This wasn't 2008. This was 1989, and it was called the savings and loan crisis. Between 1986 and 1995, nearly half of America's savings and loan institutions failed. That's 1,043 banks gone. To put that in perspective, imagine if today half of all credit unions in America suddenly collapsed. The cleanup cost every single American taxpayer about $500. That's $1,300 in today's money. 5 U.S. senators would be investigated for corruption. Hundreds of executives would go to prison, and somehow, most Americans today have never even heard of it. What you're about to learn is how a boring type of bank that was supposed to help regular Americans buy homes turned into a casino for the wealthy, crashed the economy, and created a blueprint for every financial crisis that followed. If you want to understand the economic stories that shaped America while most people weren't paying attention, hit that like button and subscribe to The Sleeping Economist. Ring the notification bell because we're uncovering the financial events you slept through. And trust me, they're still affecting your money today. Chapter 1. The All-American Dream Machine. To understand how this disaster happened, we need to go back to your grandparents' era. After World War II, America had a problem. A good problem, but still a problem. Millions of veterans were coming home, starting families, and they all wanted houses. But regular banks wouldn't give them mortgages. Banks wanted to lend money for 90 days, maybe a year, not 30 years. Enter the Savings and Loan Association, or S&L. Think of S&Ls as the friendly neighborhood bank specifically designed to help regular people buy homes. They had one simple business model that worked for decades. Take in deposits from local savers, pay them 3% interest, lend that money out as home mortgages at 6% interest, pocket the 3% difference. Boring? Absolutely. Profitable? Like clockwork. The government loved S&Ls so much they gave them special treatment. They could pay slightly higher interest rates than regular banks on savings accounts. In exchange, they had to follow strict rules. At least 80% of their loans had to be home mortgages. No risky business ventures, no crazy investments, just home loans for regular Americans. By 1980, there were about 4,000 S&Ls across America, holding $600 billion in assets. That's $2.1 trillion in today's money. Small towns often had just one S&L that everyone used. The Bailey Building and Loan from It's a Wonderful Life? That was an S&L. These institutions held the mortgages for 67% of American homes. But here's where our story takes a dark turn. In the late 1970s, inflation exploded. Suddenly, S&Ls were paying 15% interest to attract deposits, but they were stuck collecting 6% on all those old mortgages they'd written. Imagine running a business where you buy something for $15 but can only sell it for $6. You'd go broke, and that's exactly what started happening. By 1980, S&Ls were losing $6 billion a year. The entire industry was technically insolvent. Washington had two choices: let them all fail, destroying small-town America's banking system, or change the rules. They chose to change the rules, and that decision would cost taxpayers $124 billion. Chapter 2. The Deregulation Disaster. This brings us to 1982, when Congress passed something called the Garn-St. Germain Act. President Reagan called it the most important legislation for financial institutions in 50 years. He wasn't wrong, but not in the way he meant. The new law was like giving a teenager who just failed their driving test the keys to a Ferrari. Overnight, S&Ls could now invest in commercial real estate, business loans, junk bonds, anything they wanted. That rule about 80% home mortgages? Gone. Those boring executives who'd spent 30 years making careful home loans? They were now expected to compete with Wall Street. But here's the truly insane part. While giving S&Ls all this new freedom, the government kept something called deposit insurance. Every account up to $100,000 was guaranteed by the federal government. This meant S&Ls could make the riskiest bets imaginable, and if they failed, taxpayers would cover the losses. Imagine if Las Vegas casinos worked this way. You could gamble all you want, and if you lost, the government would refund your money. How carefully would you bet? State regulations got even crazier. California let S&Ls invest 100% of their deposits in any venture they wanted. Texas went further. S&Ls could literally buy anything: racetracks, restaurants, yacht dealerships. One S&L bought a fleet of Learjets. Another invested in a Buffalo sperm bank. I'm not making this up. The gold rush was on. Developers realized they could buy an S&L for a few $1,000,000 and instantly have access to hundreds of millions in federally insured deposits to play with. Between 1982 and 1985, S&L assets in Texas tripled. In California, they doubled. Sleepy little S&Ls that had served communities for generations were suddenly making billion-dollar bets on shopping malls in the desert and half-finished condo towers. Edwin Gray, the federal regulator in charge of S&Ls, started seeing the warning signs by 1984. S&Ls were growing at 50% per year, impossible for any legitimate business. When he tried to sound the alarm, the industry fought back. They had Congress on their side, thanks to $11 million in political contributions. Gray later said it was like trying to stop a freight train with a feather. Chapter 3. The Empire Builders. By 1985, a new breed of S&L executive had emerged. These weren't your grandfather's boring bankers. They were empire builders, and the biggest of them all was Charles Keating of Lincoln Savings and Loan. Keating bought Lincoln Savings in 1984 for $51 million. Within 4 years, he'd turned it into a $5 billion giant. How? By using depositors' money like his personal piggy bank. He bought a $40 million hotel in Phoenix. He invested $100 million in junk bonds. He paid himself $34 million in salary over 4 years. He even used Lincoln's money to buy a house for his son with an Olympic-sized swimming pool. But Keating's real innovation was selling something called subordinated debentures. These were basically IOUs that looked like insured deposits but weren't. Lincoln's employees, many making minimum wage, were given scripts to sell these to retirees who came in looking for safe CDs. This pays higher interest, and it's just as safe, they'd say. It was a lie. When Lincoln failed, 23,000 customers, mostly elderly retirees, lost $250 million. Then there was Don Dixon of Vernon Savings in Texas. Dixon used depositors' money to buy a $2 million yacht, prostitutes for business partners, and a sister company that did nothing but throw parties. One infamous party on Dixon's yacht included hired women and a hot tub. The bank's president literally left the country with $22 million in a Swiss bank account. When Vernon failed, it cost taxpayers $1.3 billion. David Paul of Centrust in Miami spent $29 million of depositors' money on art, including a $12 million Rubens painting for his office. He threw a party that cost $122,000 just for flowers. His bank's failure cost taxpayers $2 billion. But here's where it gets truly shocking. Federal regulators knew about these problems. By 1987, they had identified 250 S&Ls that were insolvent. But Congress, influenced by industry lobbying, wouldn't give them money to shut them down. So these zombie banks kept operating, taking in new deposits and making increasingly desperate bets to try to gamble their way back to solvency. The situation exploded in 1988. In that year alone, 190 S&Ls failed. The Federal Savings and Loan Insurance Corporation, the agency that insured deposits, went broke. It needed $50 billion just to handle the failures already in the pipeline. Congress finally faced reality. This wasn't a problem that would fix itself. Chapter 4. The Political Earthquake. The political fallout began with 5 senators who became known as the Keating Five. Charles Keating had given these senators $1.3 million in campaign contributions. In return, they pressured federal regulators to back off their investigation of Lincoln Savings. The meetings were brazen. In April 1987, Senators John McCain, John Glenn, Dennis DeConcini, Alan Cranston, and Donald Regal met with regulators and essentially told them to leave Lincoln alone. One regulator later testified it was the most inappropriate meeting he'd attended in his career. Lincoln continued operating for 2 more years, ultimately costing taxpayers an extra $2 billion. When the scandal broke, it destroyed careers. Senator Cranston was formally reprimanded by the Senate. The others faced years of investigations. John McCain called it the worst mistake of his life. John Glenn, an American hero who'd orbited the Earth, saw his reputation tarnished forever. But the political damage went deeper. President George H.W. Bush had promised no new taxes, but the S&L cleanup needed money. Lots of it. In August 1989, he signed the Financial Institutions Reform Act, creating the Resolution Trust Corporation to handle the cleanup. The initial price tag, $50 billion. Within a year, it ballooned to $124 billion. The RTC became the largest owner of real estate in American history. It inherited 747 failed S&Ls with assets nobody wanted, half-built shopping malls, empty office towers, worthless land in the desert. In Texas alone, the RTC owned 1,100 pieces of commercial property. They had to sell a 20-story office building in Houston for $525,000, less than the cost of a suburban house. The crisis crushed entire regions. Texas lost 250 S&Ls. The state's economy didn't fully recover for a decade. In 1988, the highest price paid for a barrel of Texas oil was $16. Real estate prices collapsed 40%. Houston alone had 30 million square feet of empty office space, enough to house every office worker in Tampa, Orlando, and Jacksonville combined. The human cost was devastating. In communities across America, people who'd saved their entire lives lost everything. One 73-year-old widow in California lost her $285,000 life savings when Lincoln failed. She'd specifically asked if her money was safe and was told it was government insured. It wasn't. Chapter 5. The Reckoning. The legal aftermath was unprecedented. Over 1,000 S&L executives were prosecuted for fraud. Charles Keating got 10 years in prison, though he served less than 5. Don Dixon got 5 years. David Paul got 11 years. The Justice Department created special task forces just to handle S&L crimes. But here's what's remarkable. For every executive prosecuted, dozens walked away wealthy. They'd paid themselves millions in bonuses while their banks collapsed. One study found that S&L executives extracted $40 billion in compensation during the 1980s, money that came directly from depositors and taxpayers. The regulatory system was completely rebuilt. The Federal Home Loan Bank Board, which had overseen S&Ls, was abolished. The Office of Thrift Supervision took its place, with stricter rules and more power. Capital requirements were raised. Banks now needed more of their own money at risk. The days of buying a bank with pocket change and gambling with federal insurance were over. Congress passed new laws making bank fraud easier to prosecute. They created prompt corrective action rules. Regulators now had to shut down troubled banks quickly, not let them gamble their way deeper into insolvency. These reforms worked. When the 2008 crisis hit, the commercial banking system was much stronger because of lessons learned from the S&L disaster. The S&L industry itself essentially disappeared. In 1980, there were 4,000 S&Ls. Today, fewer than 600 remain, and they hold less than 5% of American mortgages. An entire sector of American finance, one that had existed since the 1830s and helped build suburban America, was effectively extinct. But the most lasting impact was psychological. The S&L crisis proved that financial deregulation without proper oversight was catastrophic. It showed that deposit insurance created moral hazard. When profits are private but losses are public, people take insane risks. These lessons were clear, documented, and supposedly learned, which makes what happened next even more incredible. Within 10 years, many of these hard-won regulations were being weakened again. The Glass-Steagall Act, which separated commercial and investment banking, was repealed in 1999. By 2008, we'd see an even bigger crisis following the exact same pattern: deregulation, excessive risk-taking with other people's money, regulators asleep at the wheel, and taxpayers left with the bill. Chapter 6. The lesson we keep forgetting. So, what can regular people learn from a crisis that happened 35 years ago? More than you might think, because the patterns keep repeating, and the next crisis is already being built somewhere in our financial system. First, when everyone's getting rich in the same investment, you're probably near the end, not the beginning. In the 1980s, it was commercial real estate in Texas. Every dentist, doctor, and small business owner was buying strip malls and office buildings. Sound familiar? In the 2000s, it was houses everywhere. Your barber was flipping condos. In 2021, it was cryptocurrency. Teenagers were giving investment advice on TikTok. Today, maybe it's AI stocks or whatever asset class everyone at your office can't stop talking about. The specific asset changes, but the pattern doesn't. Easy money leads to bubbles, and bubbles always pop. Here's a rule that would have saved people millions. If your taxi driver is giving you investment tips about it, you're too late. During the S&L boom, Texas cab drivers were literally buying commercial real estate partnerships. In 2007, Las Vegas strippers owned 5 investment properties. When people with no expertise in an asset class are all in, smart money is heading for the exits. Second, complexity is where fraud hides. When Lincoln Savings sold those subordinated debentures to retirees, they used complicated language to hide a simple truth. This wasn't insured. The salespeople themselves often didn't understand what they were selling. They just knew it paid higher commissions. Today's equivalent might be cryptocurrency exchanges promising guaranteed returns through yield farming or staking rewards, or those complex financial products with names like structured notes or non-traded REITs that even professionals struggle to understand. Here's a timeless test. If you can't explain an investment to a 10-year-old in 2 sentences, you probably shouldn't buy it. Warren Buffett follows this rule, and he's done okay. Third, political connections and financial crime go hand in hand. The Keating Five showed how campaign contributions could buy protection from regulators. But it wasn't just them. The entire S&L industry spent $11 million on lobbying in the 1980s, pocket change compared to the billions they'd steal. When you see financial executives making huge political donations, hiring former regulators, or appointing politicians to their boards, ask yourself, are they buying influence or expertise? Today, when crypto exchanges hire former Treasury secretaries or banks put former Fed officials on payroll, remember Charles Keating. He didn't just donate to senators, he put them on his payroll as consultants. Senator Cranston got $850,000 for consulting that consisted of making phone calls to regulators. Fourth, deposit insurance isn't absolute protection. Yes, the FDIC and NCUA insure deposits up to $250,000 today. It was $100,000 during the S&L crisis. But as Silicon Valley Bank depositors learned in 2023, anything above that limit is at risk. And even insured deposits can be frozen for weeks during a bank failure. More importantly, insurance creates complacency. During the S&L crisis, customers chose banks offering the highest interest rates, assuming federal insurance made all banks equally safe. They didn't ask how a bank could pay 3% more than competitors. The answer? By making insanely risky bets with their money. Today, online banks offering rates way above market average deserve scrutiny, not automatic deposits. Fifth, the real cost isn't just financial. The S&L crisis destroyed communities. When small-town S&Ls failed, local businesses couldn't get loans, construction workers lost jobs, real estate agents became unemployed. In Texas oil towns, the unemployment rate hit 25%. Families lost homes their parents had built. Retirees who'd saved for 40 years ended up on food stamps. The psychological scars lasted longer than the economic ones. A generation of Americans learned that institutions their grandparents trusted could be looted by executives and politicians. Sixth, every financial crisis follows the same psychological pattern. First comes innovation. In the S&L case, it was deregulation and new investment powers. Then comes imitation. Everyone rushes to copy the early success stories. Then comes euphoria. People believe this time is different and old rules don't apply. Finally comes revulsion. The music stops. Everyone runs for exits and taxpayers get the bill. Finally, and most importantly, the next crisis won't look exactly like the last one, but it will rhyme. It will involve some combination of new financial instruments nobody fully understands, regulatory blind spots everyone ignores, excessive leverage everyone thinks is safe, and misaligned incentives everyone pretends don't exist. The S&L crisis cost every American family about $2,000 in today's money. The 2008 crisis cost even more, about $70,000 per family if you include lost home values and retirement accounts. The question isn't whether there will be another financial crisis. There will be. History doesn't repeat, but it rhymes, and the rhythm is getting faster. Your best defense isn't paranoia, it's education. Understanding how the S&L crisis happened helps you recognize similar patterns today. The S&L crisis taught us that in finance, the house always wins, unless the house is your savings and loan, in which case, everyone loses except the executives who already cashed out. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel because we're just getting started with these financial educational mysteries.